Kent Fitzpatrick is here. He is the managing director of asset strategy. He's been doing it for over 30 years, so he has a ton of experience around financial planning, estate planning, um, and investment advice in general. And in today's episode, we're going to do a deep dive on Delaware Statutory Trusts, also known as DSTs. A lot of people, in my experience, don't know that much about them. So I'm really excited to kind of do a deep dive on this particular topic to kind of introduce people to what they are, when they might make sense, when they might not make sense, what they're all about. So Kent, thanks for having us. Maybe can you just maybe give a quick overview to people who are listening in, just kind of explaining how did you get into this business? I'm curious to, I actually don't know, like what is your story, 30 years ago or 35 years ago, whenever it was, and how did you get into this to start?
Yeah, great. Well, first off, thank you for having me on your show. This is really exciting for us too. So my story is a little bit different because I always say it was fate. I was one of six kids, and I always said someone had to go in the old man's business. But my dad's background was really more selling annuities to school teachers back when interest rates were 14% guaranteed. Little different environment today. I was an economics background and really have a diverse practice today from a diverse background. So we have 7 different companies under the asset strategy umbrella, if you will. So we have an SEC registered investment advisor, fee-only advice. We do a lot of retirement consulting for business and nonprofits. We have an insurance brokerage. We do a lot of estate planning. We have a securities firm. We have a marketing communication company. We have a tax consulting firm. So we have a lot of different tools in the tool chest, but a lot of what we do centers around tax mitigation strategies. And I think that's kind of what brought us to this topic today, because we have worked with a number of clients that have been real estate investors. I love real estate. I've invested in real estate for many, many years myself. But it's really what happens when you're looking to exit, or maybe you have great cash flowing properties. They've run up in value, but the kids don't want it. The kids moved across the country. It was dad or mom's passion, and it's not their passion project. So, what do you do as a owner of investment real estate, and what are your options when you get to that kind of crossroads?
Yeah, definitely. And maybe to start, just to back up a little bit, I think some people listening might know what a 1031 exchange is. Some definitely won't. But can you kind of, just to start high level with the Delaware Statutory Trust, can you just kind of explain very in basic, simple terms for someone who's never heard of this before, what is a DST? Like what actually does that mean, a Delaware Statutory Trust?
Yeah. So, and I think you hit on a good point, because I think some people confuse, is it DST opposite of a 1031? The reality is 1031s have been in the tax code for over 100 years. They date back to like 1921, and that's really when railroads were opening up the West, and they'd go across farmers' land, and it was basically a benefit to exchange like-kind property. And it's had its challenges over the years, and I would say that one of the biggest challenges came out of the Tax Cuts and Jobs Act, which became law in 2018, which basically said you can no longer exchange anything but real property, meaning the real estate. It used to be, think about if I had cows and tractors and silage or whatnot, then I want to exchange everything to avoid the tax ramifications. DSTs came as I guess, response to what was commonly referred to as a TIC, or a tenant in common. TICs had a lot of problems because they had a limited number of owners. So if you and I and 4 other people wanted to buy a property together, and let's say you and I say, gee, that roof's 35 years old, we really got to replace it, it's going to cost $500,000, and the other investors said no, well, it was a lot of fighting and lawsuits and arm wrestling and whatnot. So Delaware Statutory Trusts, or I'll refer to it as DST throughout this talk, was introduced as more or less a response to the TICs, to kind of make them a lot more transparent and to allow for investor protection, so you don't have that infighting. But it's a way of owning fractional ownership for multiple investors in a passive investment. And so we'll talk about that a little later through the conversation, but because I know a lot of people who are active hands-on owners, they've been managing properties, dealing with tenants and insurance and all the issues that come with being a landlord. And again, don't forget, I am a landlord too, so I got my stripes on my back. So this is really a way of converting from active to passive and using institutional real estate and institutional partners.
Got it. And to kind of summarize, like, whereas, a traditional 1031 exchange, maybe you sell your property and you put it into a bigger property and you continue to actively manage. A DST, you sell your property, you take the proceeds, and now you have a fractional ownership into maybe a 400 unit complex somewhere or a strip mall or something like this or whatever. And you're no longer managing that new property, but instead you're getting paid some amount at some frequency. Is that kind of on a high level how it works?
Yeah, and I guess, and we'll share a visual for your audience too, but I think a good way of thinking about it, I like to call it the decision tree. So I'm an owner of investment real estate, so it's not personal property, it's not my vacation home, it's investment real estate, and there's multiple asset classes, we can talk about that in a minute. But the decision tree is I'm going to sell this investment real estate, and I'm going to be subject to 4 different taxes. Federal capital gains, state capital gains, unless you're in one of the 7 tax-free states, depreciation recapture, or maybe recaptured depreciation. There's 2 different flavors there, and then net investment income. So I'm either going to pay those taxes, or I'm going to entertain doing a 1031 exchange. If I'm going to do a 1031 exchange, I then have to engage a qualified intermediary. So someone has to receive those funds at the closing. So I have a lot of times where someone will call us, they download one of our brochures, or they heard a podcast and say, hey, I want to learn more about that DST thing. How's that work? I say, well, when is your transaction? Well, I sold the property a month ago. It's too late. So because they cannot take constructive receipt. So that's really the role of the qualified intermediary. So assuming that I'm not going to pay the taxes, I want to do an exchange, I have a qualified intermediary that holds onto those funds. Well, now the clock starts ticking. I have 45 days to identify property, and I have a total of 180 days to close. Now, let's back up and talk about identifying property. Now I have 2 more decision trees. One is I'm going to continue being an active landlord where, sometimes we refer to it as the terrible T's, and we've all been there, term rights, teenagers, taxes, or I want to say now I want to go play golf. I don't want to be getting the calls in the middle of the night. I've done that for, the last 30 years. I want to be passive. Yeah, I'm done. Yeah. But so a DST is for, number one, accredited investors, which the definition with the SEC is I have to have income in excess of $200,000 as an individual or $300,000 as a married filing jointly, or have net worth in excess of $1 million, not including my primary residence. So certainly in this real estate market, if I bought a 3-family in the greater Boston area 20 years ago, it's easily selling for in excess of $1 million. So by default, I'm most likely already qualifying for accredited investor. So you have all of the same kind of steps and requirements that I want to do an exchange. It's just really the decision comes down to, do I want to continue being hands-on and involved, or do I want to diversify and be in a passive role?
Got it. Yeah, no, that's super helpful. And I think one thing that I just want to go into a little bit around these DSTs is kind of like, having gone through this a bunch and you talk to a lot of people in a lot of different situations, can you kind of talk through a little bit, what is that sweet spot where you start talking to someone and you kind of know in a second, the DST is perfect for you. What you're describing, you fit the profile of someone where it just makes it's common sense to consider a DST. And then on the flip end, you start talking in 5 minutes, you say, you know what, it just doesn't make sense. I know you just listened to this podcast, but this just isn't right for you in this particular scenario. Can you kind of go through the 2 ends of that spectrum a little bit?
Yeah, I think that's a really good question, because I think that it's really someone that is tired of being an active manager of their real estate. They want to take a back seat. They want to be passive. So that's kind of key. Someone who's 45 years old and they're fixing and flipping and they're buying and selling and so forth, that's probably not them. but the man or woman who, let's say, has been a landlord, they're maybe looking at retirement, they want to maybe move somewhere, that they could be a good candidate. Someone that says, you know what, if I do this exchange, I have to replace, debt for debt, equity for equity. Well, maybe inventory is terrible. Maybe the debt markets are terrible. Maybe I don't want to be in, where low cap rate compression, the Northeast. Like we see a lot of demographic shift, people moving from high tax states like California and New York or even New England to places like, Tennessee or Florida or Texas, where it's tax free. So maybe if I'm looking at where the demographic shift is, I want to be a landlord in maybe an Amazon fulfillment center or a student housing project or a multifamily, but I don't want to be managing something that's in Tennessee, but I feel like that's where I'm going to make money as a investment property owner and not trigger all the taxes when I want to diversify some portion of my portfolio. So it's not an all or nothing proposition too. So if I want to, I'm selling my property for $1 million and I want to downsize and maybe I'm going to buy something for $700,000. The DST can be, kind of a backstop to absorbing that delta. So you can do everything into a DST. You don't even have to do a DST if you want to continue being a landlord or you want to pay the taxes, because there's situations where, we've talked people out of doing a 1031 in total. If they have a lot of loss carry forwards or other ways of offsetting those taxes, well, maybe that's not, appropriate for them, or they don't want to be a landlord anymore, or maybe they don't like real estate as an asset class, which I think would be a mistake because it's got a pretty good track record, and they're not making, more real estate. So
Yeah, I think that's actually what you just brought up with the sort of it can be like a catch-all, these DSTs. I think that's a really good point because I think one of the traps that I see a lot of landlords that I work with get into is, they bought a property a long time ago, maybe for 400,000 or 500,000. It blew up. Now it's 1.5 million, let's say, and now they feel this pressure of I need to buy a property at 1.5 or more. And so sometimes what happens is I might see an off market or a great opportunity, but it might be a million or 1.1. And now they say, well, that's not going to work for me because even though it's a great deal, I don't want to pay those capital gains, depreciation, recapture, et cetera, and get killed on that final 400. So what you're saying is if there's a great opportunity, it's less than that, you can still buy it and still potentially upgrade and be in a better spot with that, going from your current real estate to the new opportunity that might have more upside, then take the extra excess and put it in a DST. And that's kind of another thing I kind of want to get into a little bit, which is a lot of people I work with, they say, okay, I'm familiar with my area, wherever it is. I'm in Cambridge, I'm in Malden, I'm in Medford. I know my area. Where is this money going? Like, what are these properties? Can you talk a little bit about maybe geographically, if there's certain areas where these DSTs opportunities tend to be located, and also like the property types, the asset types, and what they actually would be
sure.
buying,
Yeah, so there was a lot packed into that question, so so I'll try to work through it with you. So let me give you a sense of the DST marketplace. So in 2024, there was just shy of $6 billion of capital raised. There were 211 offerings by over 65 active sponsors. So some of the names people may or may not be familiar with, but folks like Kent Fitzpatrick, Jones Lang LaSalle, Inland, Ares, Cantor, BlackRock, Blue Rock. So these are large institutional, multi-billion-dollar players that some may be focused just in DSTs, or some are very large, diversified institutional players. The market segments really are the same 7 food groups that any investment property or owner is looking at. So multifamily, office, industrial, retail, hospitality, self-storage, or even like, specialty, like maybe student housing, senior housing. So it's all the same food groups, but it's just packaged in a synthetic security that I'm a passive participant in. Let's see, I'm trying to remember, you had a couple more questions there. Oh yeah, the regions. I like to describe it as, again, it's really where the MSAs and where the demographics, where the growth is, and it's typically the sand states. And there's a couple of reasons there. One, you have tax advantages, places like Tennessee and Florida and Texas and so forth tax-free states. You have a graying population. We are over 3 million units of housing short in this country, and we just cannot, not catch up. And certainly, with maybe some of the headwinds of tariffs, that may be even more difficult because building costs are going to go up, materials are going to go up. We went through COVID, so we know how labor, everything went up. So this is where the smart investors looking at, what asset classes, I just ripped off, 7 of them, would be a good place for me to invest my money, and in what regions of the country? Well, it's really, where are the demographics, driving that? So it's the sand states, or sometimes they call it the smile states, are really where you see a lot of these, because it's not to say that you won't see a DST in New England. There's actually a couple available right now. It's just, these institutional people are either buying. Let's take a multifamily example. They're buying either a brand new property that may be 70% leased, and part of their business plan is, we're going to get this to full occupancy, maybe 94, 95% occupancy. We're going to stabilize the asset. We're going to increase amenities. We want to get net operating income up and cash flow, and ultimately we're going to sell it. That's one category. Another example would be, maybe someone's buying that same multifamily example. These are 100, 200 unit type of garden style varieties, or student housing examples, that maybe it's a 15-year-old property. Kitchens haven't been updated. They haven't modernized, Nest thermostats. There's no, dog walking. There's no, the grounds aren't upkept. Maybe it was a mom and pop operation. So again, they're going to go in, put some money in right up front to modernize, the kitchens. They want to, get the rents up. They want to get the tenancy up, and then again stabilize that and ultimately sell. And all of these institutional managers that are structuring these, they're investing alongside of you. So the typical life cycle of a DST is somewhere between 5 to 7 years. There's a couple things going on, because a lot of the debt, that if there's debt, because there's some debt-free DSTs, depending upon if you're exchanging all cash or you need debt, is typically a 10-year interest-only structure. So they're incentivized to execute their business plan, stabilize that asset, and sell it to make a profit alongside you. So it's not just about the net operating income, cash flow, and we'll talk about the different ways you're making money in any real estate, but also in DST. So hopefully I hit all of your questions, because there was a bunch packed in there.
No, that was really interesting, and that actually brings up another question I had, which is like, okay, so I think a lot of people who are property owners for a long time, they bought the property maybe, and they've owned it for a very long time, many decades. So they may not be used to this idea of there's a timeline here. So I think 2 questions that came to mind while you were talking is, number one, what happens when the period is over? Say 7 years go by. And the period's over, what then happens? And then the second question related to that is there an ability to leave earlier? Let's say in the middle of it, you say, I want to access these funds, or I want to do something. So 2 separate questions, but both around exiting, one at the just natural end, and one can you get out early, basically?
Yeah, so really there's 4 things you can do at the end of that cycle. So let's say that you're in year 5, year 6, the sponsor says, hey, we've got a fantastic offer. We're going to sell this. We're going to usually give you, several months lead time. So, all right, what do you do next? So number 1, you can do a 1031 into a DST of what may be available from that sponsor, or go back into the marketplace to see what's competitive, what asset classes, what sort of yields, so forth. So I can do another DST as option 1. Option 2, I could do what's called a 721 UPREIT. So what a 721 UPREIT is it's basically a form of a DST. So it's still a securitized form of owning that fractional real estate. But after 2 years, that investment, so let's say it's this multifamily, or maybe it's a triple net lease or self-storage or whatever the asset is, maybe the sponsor, like a Jones Lang LaSalle, wants that to ultimately become part of a massive multi-billion-dollar REIT. So they'll allow people to do exchanges into that DST. The IRS requires it to be held there for 2 years, and then that can be converted to up into the master real estate trust. So that's called a 721 UPREIT. The there's an upside and downside to that. The upside is it's a quicker path to liquidity because I can sell a fractional interest in a REIT, which I can't do that in a DST. So maybe that's a quicker path. But the downside is I can no longer do further exchanges in 1031. So for certain people, if they say, gee, Kent, the average hold on a DST might be 5 to 7 years, is there any way I can get access to that, sooner? Well, the answer is sure, if you wanted to put a portion of your portfolio into a 721. So that's the second one. The third is maybe I miss being a landlord. So maybe I want that fee simple property. Maybe I want to buy that, single family down the Cape and rent it out. So you can go back into fee simple real estate. And then the fourth is I can say, you know what, I'm going to pay those taxes. Now, I don't know why you do that because, as you said before, there's some great estate planning benefits to this because at death, I can get a full step up in basis and pay no taxes. Mm-hmm. So usually real estate, whether it's securitized through a DST structure or fee simple real estate, it's the swap till you drop, right? So you're getting great cash flow, but you're also getting great estate planning benefits as well.
Mm-hmm. No, it's really helpful. Another question I had that I think.
So there was a second part to your question there too.
Yeah,
so
exiting early, yes. Sorry.
Oh, yeah, that was it. So again, these are illiquid securities, but things happen. So if someone died, let's talk about that because I just mentioned step up in basis. Mm-hmm. So if I own investment real estate, fee simple real estate, and I die, my heirs get a step up in basis. The same holds true in a DST. I get a full step up in basis. The difference is I don't have that liquidity. So again, if I die year 4 into this DST, and it may be a couple years before they complete their master plan and they want to liquidate that asset, then my heirs would still have to continue being a shareholder. Now, what they can do is.
Oh, sorry.
Yeah, there's no. Yeah, that's all right. There's no formal secondary market for DSTs, but typically what will happen is the sponsor will petition other shareholders saying, "Hey, we have one of the investors has a $200,000 position in this DST. Does anyone else want to acquire that as part of their holding?" So they'll put it out to current investors first and foremost. There is no organized secondary market, but there is an option for secondary market. But what is certain is they can hold it to the full cycle. They can petition other shareholders or find a third-party purchaser, which is again not an organized marketplace.
Got it. Okay, that's really helpful. Thanks for explaining that. Okay, so
yeah.
This is another thing that's kind of interesting to me is like. I think one of the challenges with sort of a more traditional 1031 exchange, like you said, you have 45 days to identify, 180 days to close, and unless you really have a game plan and execute everything correctly, you can really feel like you have a gun to your head. It seems like with these DSTs, you might have some level of planning in the sense that you can look at some options beforehand. Can you talk through how that works? Is it the type of thing where, when these DST opportunities come up, you have a day and you have to snatch it up, kind of like, just like a traditional 1031 where you got to move very quickly? Or is there a menu of 20, 30 options and you can take your time, you can go for a higher risk asset that might have more upside but be a bit riskier versus some other assets that might be a little bit of a lower return but safer? Like, can you walk through a little bit about the selection process?
Absolutely. And Sage, it's a really good question and an important question too, because I mentioned to you earlier in our conversation that for 2024, there were over 211 DSTs offered through over 65 different sponsors. So this is really point in time because let's say I'm an Inland or Blue Rock or Cantor and I have 1 or 2 DSTs in the marketplace. Well, once I've sold out that particular fund, it's closed. And so they'll typically the bigger sponsors will come out with another fund. But if I've got my heart set on a particular DST because I like the asset class, I like the location, I like all the benefits of it. Well, it's point in time because if my closing isn't for 3 more months, that fund may not be available. So when I say point in time, it's when my closing happens, it's what's available in that marketplace because we can make a reservation for a client, but it's really a first come, first serve in terms of, who's getting that position. So no different in a hot real estate market. Hot DSTs, they fill up and they go fast, just like, the same thing in fee simple real estate as well. What was the second part of that question?
Um, I don't remember off the top of my head, but so it sounds like it's actually pretty similar to. I was just listening to what you were saying, so I mean that sounds pretty similar to real estate. So it sounds like there is no ability to say, okay, I'm going to take this. Just give me, hey guys, give me which makes sense. Give me 3 months. I promise I'm selling. They have to take what they can get when they can get it. So I guess I'm curious, like, from a process standpoint. How would you recommend? So let's say okay, someone comes to me, they say, hey Sage, I want to sell my fourplex in Somerville. I think we're going to get about $2.5 million for it. It's not going to close for another 3 months. At what point should they begin the conversation with someone like you and start looking at these assets? Should it be before they list, after the PNS is signed? Can you walk through the timing around it?
Yes, thank you. So the difference with a DST is we can literally close in 24 hours, 48 hours if we had to. So we've had those calls where someone's got their funds at the qualified intermediary. They're on day 43. They've been scouring the marketplace. They couldn't find anything they want. And it's like, oh my gosh, I'm going to trigger, hundreds of thousands of dollars worth of taxes. And so sometimes we get those panicked calls and we can still place that, exchange for them within 24 or 48 hours notice. Now, I want to talk to you about access to the marketplace too, because again, I mentioned that this is a securitized form of real estate. So you have to be working with someone who has a securities license, not a real estate person, because these are securitized forms of real estate. So if someone says they call up their broker or their financial planner, they either will not know anything about this space. Number two, maybe their broker dealer has a very limited inventory in terms of what they have available on their shelf. Or three, an organization like ours, it's not a kind of a sideline. It's something that we are focused in. So we have access and we have a due diligence team that's constantly evaluating not just the fund or the properties, but the sponsor themselves, looking at their business plans, their reputation, their track records, also looking at issues related to the site, because there could be a great asset in a really bad area, or maybe there's a for sale lot next door, and maybe they're not the prettiest property in town anymore. 2 years from now, when that property gets fully developed next door to them. So there's a due diligence process. So I think the people, the firms that you work with like ours, it has to be something that it's not a passing fad, because access to the marketplace, and then we were talking about reservations. So because of the volume, so our broker dealer does roughly about 13% of the entire marketplace. So we do have clout with the sponsors because of the volume of business that we do. And we track probably somewhere between 30 to 35 different funds, month to month, and the inventory is constantly changing. So we've got to be on top of that. And we try to send, a member of our team to go visit these properties so we get a feel for, what the asset class looks like, what the sponsor looks like, meet the senior management. So you really learn a lot from, boots on the ground, not just pretty pictures.
That sounds good. One question that kind of came to mind. I just thought of certain owners I know have a certain type of personality. If I was an owner, am I able to fly to that asset and see it and look at it? Because I think that there are some people where they say, I want to see this thing, I want to meet these people. What kind, or is it like you kind of have to do your research, look at the numbers, and leave it at that?
No, absolutely, and a lot of the sponsors will encourage that, because again, you're buying. That's why it's allowable under the 1031 exchange, because unlike a real estate mutual fund or a REIT, I'm buying in those instruments. I'm actually not buying the underlying real estate. I'm buying a share of a portfolio. With a DST, I'm actually buying a fractional interest through this trust. that own. So if it's a $20 million project and I put $1 million in, I own 1/20th of that property. I have someone else who's managing it and doing all the accounting and leasing and so forth, but I own 1/20th of that trust. So it's a key differentiation. And we have a lot of clients that same thing, that they want to go kick the tires or go visit the site, and we encourage that. And again, sometimes they get a flavor for what that sponsor is doing. So if there's a property right in our backyard here in New England, we can say, listen, yeah, you can fly down to Tennessee or wherever the property may be, or you can also take a look at other assets that this same company is managing and get a sense of it. So we certainly encourage that.
Very cool. Another thing that I'm sure as people are listening are thinking about is returns. And I just want to add the caveat before we kind of get into returns. Obviously, there's no guarantee with returns. You got to do your own due diligence. You can't go, you can't listen to this podcast and say, well, you said 4 to, whatever numbers here. But are you able to talk through a little bit around returns
Sure.
in
Yeah.
terms of, is there a range? If, like, let's say I maybe have a higher risk tolerance, is it possible to get, a higher range return with a bit more risk versus a low? Kind of what's the range of what we can expect here roughly based on historical data in the past?
Yeah.
Again, who knows what'll happen in the future?
Yeah, well, and I actually love this question because people that are investing in investment real estate, they know either directly or indirectly. There's really 4, and I'd say there's a bonus. There's 5 ways you make money in real estate, and I always like to use the acronym MATC. So number 1 is mortgage reduction. So if I have tenants that are basically paying my lights, heat, phone, all of the expenses and mortgage reduction, I'm making money by someone else paying the bills for me. Is for appreciation. So obviously, real estate as an asset class, and again, depending upon the 7 food groups that you're invested in, is a great long-term investment. So I'm going to make money through appreciation. T is for tax benefits or tax deductions. So we have this 8th grade wonder of the world called depreciation. So in a residential asset, whether it's student housing, senior housing, multifamily, you get to depreciate over 27 and a half years. Other assets, think of like a Amazon, storage or warehouse or triple net, that's non-residential, you have 39 years to depreciate it. So the same is true in a DST that's investing in those same asset classes. I've got depreciation to offset taxable income. And the C of my MATC is cash flow. So that's really net operating income. So after expenses and insurance and so forth, what is my net operating income? And the bonus round that I like to throw in there too, not everyone agrees with this, but is I, so MATC I is for inflation hedge, because if the dollar is deflating, because of how the government prints money and keeps increasing our national debt, you're basically paying down with deflated dollars for a fixed payment. So long-winded answer of how people make money in real estate, and it's true of Delaware Statutory Trusts as well. The marketplace for current day yield, because again, cash flow is after your net operating income, no different than if I've got a 3-family in Somerville. I'd say that the range of cash flow right now is somewhere between maybe 4.5 to 6.5. And again, it depends upon the asset class, depends upon the property, depends upon the risk elements. Some things that might be paying a higher yield may not have as much appreciation potential. So like a triple net lease, you really make money on a triple net lease. If I've got a 15-year Walgreens or CVS, with escalators and renewal bumps and so forth, that's great. But is the asset appreciating, or is it a cash flow play? Because if I'm banking on cap rate compression, that might be tough in this market. So versus, let's say, a multifamily in a demand area with a great asset class, it may be more modest yield, but I'm going to get a great, much greater, appreciation potential on that asset. And I'm looking at, in the DST space, kind of that 5 to 7 year time horizon, all the sponsors that we work with will publish their history across different asset classes, different time periods. And I think the biggest challenging period we just went through was COVID, because whether I, owned an institutional, size of an institutional portfolio through a DST, or I owned that property directly, if people stop paying their rents, or my insurance rates, doubled or tripled, which they certainly did in places like Florida, that's going to impact the entire real estate marketplace, not just DSTs or me buying direct real estate. So I think, well, I've said a lot there, but I think, MATC is, plus the I is really how you make real estate. You have net operating income, ranges, and it really depends upon the asset classes as well.
That's really interesting. I didn't really think a lot about that before I asked that question, but I'm realizing like kind of what you're saying is depending on what you want to focus on, you could focus on maybe something safer like a triple net, that might give you some really solid cash flow over those 5 to 7 years. But then at the end of that period, you may not see a big bump, whereas other assets, maybe you have a not so great cash flow over those 5, 7 years, but at the end of it, you see a really big bump and then you can do something. So depending on what your goals are, there's a couple different options. Is that kind of what you're saying?
Exactly. And one other thing I want to add too, because I think it's a very important point with DSTs, which you don't have with, direct fee simple real estate, is non-recourse debt. So let's just play out an example. So let's say I have a property I bought 25 years ago for 400,000, and for simple math, it's worth $1.4 million. And let's say I should have made my example a little bit longer, because if it was 27 and a half years, the 400,000 would be fully depreciated. So let's just say it's fully depreciated. So I have a basis of zero because I fully depreciated that. So I have a potential capital gain in that example of $1.4 million. But let's say I have $300,000 of debt remaining. When I sell that property, what happens at the closing? Well, I get the wire from the buyer, and then I have to pay off the $300,000 to the bank, and now I've got $1.1 million, and next April 15th is when I'll have to pay those taxes. Well, the rule of 1031 is replacing, like-kind property. So you have to replace the same amount of debt and the same amount of equity, or you can reduce debt by paying it down. But if I go and buy a fee simple property, I'm back in the marketplace, putting my balance sheet on the line. Maybe I'm borrowing now at 7-8%, depending upon the asset class. Maybe the inventory's not there, but if I replace that with a DST, and again, I said before, the DSTs can have zero debt. They can be designed to have high debt to kind of be soaking up someone's debt, or somewhere in between. So let's say that I need a 20% debt because I have a loan to value of, let's say, 20%, just making up a number. I can find a DST or put together a portfolio of DSTs to replace that 20%. But that debt is debt of the trust. It's not my personal debt. So I've just gone from recourse debt, where it's my balance sheet being tied up with direct ownership, to a situation where it's non-recourse debt through a DST. So in a high lending market with maybe challenging replacement, that's another really critical differentiation with DSTs, is that non-recourse debt.
No, that's really interesting. I have one more question before we kind of move on. Just around, we talked a little bit
Sure.
about the returns and the range there. What about, I know this is a question, people are, I'm sure, thinking about, which is what are the fees involved? Is this a very expensive undertaking to go through the DST process? Are there, upfront one-off fees? Are, I'm sure, someone is taking on these projects, right? And I'm sure they have to get paid. So can you talk a little bit about how those fees are structured, or how, how that is being paid by these folks going through it?
Yeah, again, I think it's analogous to when I'm buying any real estate. So, there can be acquisition fees, there can be placement fees, there can be property management fees, but the nice thing in a DST is that the fees are basically built into the offering. So every DST, because it's a security, it has what's called a PPM, a private placement memorandum, which will basically outline, all the fees, all the expenses, what the business plan is. It's usually a couple page, legal document. But it'll disclose all that because it also has to factor in is there a disposition fee? So if we do sell this property in 7 years, has that already been factored in? Because if I go to buy a piece of real estate, I've got to find a real estate professional like yourself to help with that transaction. You have local knowledge, and you're not doing this for free. You got to get paid, but you're typically getting paid if you're a seller's broker by the seller, so it's baked into the reflected price of the sale. It's no different in a DST where if I'm a buyer, I can see what those ongoing fees are because that's what they're going to predicate my net operating income on when I'm getting distributions. And I think you had asked me before, what's the frequency? Like how often do I get income off of a DST? It's typically monthly, and I like to call it mailbox money because it's kind of autopilot. So you can set it up on direct deposit. There may be some sponsors that are quarterly, but I'd say that 99% of the industry is probably monthly. So you're not really cutting explicit checks to buy a DST. So if I'm going to put $1 million into a DST, those fees are already contemplated into the management of that fund, and they are all 100% disclosed in that PPM as well.
That's really nice. So basically right out of the gate, you know exactly what it is and you know what you're getting yourself into. So there's not really any surprises, which is kind of nice because a lot of times when you own real estate and go through the process, you don't know until you start going through it, So that is nice that it's so
Yeah.
transparent.
Well, and I mean, I'll give you a personal example. So we own an investment real estate property up in Maine. We pay a management fee. Probably a lot of your viewers might do Airbnb or whatnot. I mean, Airbnb fees are something like 24%. So was that contemplated when I bought that investment real estate property? Well, no. And I think it's the same thing here in a DST. This is already going to be a rental property, so there's probably a property manager that is getting a fee, but it's all fully transparent, fully disclosed. So.
Yeah, and I think the thing a lot of owners also kind of don't take into account is they say, "Well, I've been doing it myself," and it's like, "Well, you're getting paid for the time that you're putting in that." And so a lot of times owners say, "Well, I don't have to pay a management fee." It's like, okay, well, you've also been dealing with 40, 50 hours, every quarter of dealing with whatever, and that all goes away. So there is a cost, of course, associated with
Well,
that.
I love that one because they're saying that their time's worth nothing. Well, if someone makes a few $100,000 a year, they've got this great side hustle of real estate. Well, your time is worth something. And I'd say number two, what's the average turnover? So maybe I have an average renter in there for 2, maybe 3 years. Well, what happens at the end of that lease? Well, I'm going in, I'm putting new carpet in, I'm painting the place. Maybe I got to upgrade the utilities. So there are expenses to any real estate. And again, whether you're shouldering it yourself, you got to factor all of that in because a lot of people say, "Gee, I'm making a 10% return on my real estate portfolio," and when I start peeling back the onion, I'm like, dude, you're nowhere close to that number. Your time is worth something, and you're not factoring in all these expenses. And when you look at a Schedule E, which is where you capture your gross operating income on your 1040, there's 15 lines of expense plus depreciation. Mortgage interest, insurance, accounting, legal, so forth. So that doesn't necessarily capture all of the expenses because even on there it's capturing mortgage interest, but it doesn't capture mortgage principal payments on there. So, or what you're like we just said, what's your time worth? Or, gee, I'm going to have to spend money. I've got 7 units across my portfolio. Well, what's it cost every 2.5 years to turn that over? And I got to pay brokerage fees. I got to do marketing. I got to do all these other trash removal. So. There's more to factoring in, like what your current portfolio is actually yielding. So
Totally. Well, this has been awesome.
you're smiling because I know you're nodding your head because I think you know.
I do know. Yeah, I definitely do know. All right. Well, one more question. I know we're pretty much running out of time here, but final question I just wanted to end on. In your opinion, for DSTs, in your mind, what is the biggest benefit, and what's the biggest risk or potential downfall that you have to look out for DSTs?
Yeah, great question. So I'd say, some of the biggest benefits would be, passive ownership. If I'm ready to make that transition, for all or a portion of my portfolio to being passive, so I don't have to be, wearing the landlord hat anymore. I would also say the estate planning benefits, you're still getting the full step up in basis. We talked about the changing from recourse to non-recourse debt. I think that's a very important thing. I think diversification, because if I've got all my assets tied up in a three-family here in the Boston area, as an example, I have the ability to diversify across asset classes and regions. So I think those are probably some of the highlight reel, if you will. And I think the DST can be a soak up play where if I still want to be a landlord, but I don't want to use all of that transaction if I'm going to downsize, then the DST can be a great backup plan. I'd say that what the risks would be, we talked about it. Illiquidity. I'd say it's certainly doing the due diligence at both the sponsor level and at the property and the fund level. I'd say it's working with the right advisor, that it's not a passing fad, that they know this marketplace, they've got the relationships in place. So I think that's critical. I've seen it too many times where someone's financial advisor will say, "Oh, just pay the taxes and we'll make it up over time." Well, really, I'm 65 years old and I'm going to take on more risk to make up, a 30%, cost because you told me to pay taxes when I could have paid no taxes, deferred that, and diversified in an institutional portfolio. So, anyhow, those are some of the things that come to mind.
Well, this was awesome. Ken, thank you so much. I feel like DSTs, I remember I've been in real estate for 7 years, and I remember my first year, someone brought up DSTs. I went to my office, was talking to like 60 agents. No one knew, so few people know about this, and I'm so glad that you were able to drop your knowledge here. And I think a lot of people are going to realize that this is like, in my mind, a very critical bucket for a certain segment of people that I meet that don't really fully appreciate the opportunity. So I really appreciate your time and expertise today. Thanks, Ken.
Well, I enjoyed it. We could have probably kept talking for another hour, so maybe we'll have to hit this again sometime. But thanks for having us on your show.
Yeah, and then maybe just to really quickly to end, a final, can you just share best way to reach you, phone number, email, what's the best way to get in touch with you?
Yeah, so assetstrategy.com is our website. We have a lot of resources there. I think I have a piece here. We have a piece we call Smart Strategies, which kind of goes through a little bit more detail, some of the things we talked about with DSTs or 721s. We have a team of 20 here. We have 5 CFPs, certified financial planners on our team. We are an independent firm, so meaning we're not a wirehouse or selling any proprietary products. So we are fiduciary when we're doing managed portfolios, but we also have a lot of tax mitigation solutions. So that's really one of our sweet spots. So
awesome. Well, thanks again, Ken. I really appreciate it.
Thank you for having us. Bye now.